Management Control. Introduction. This topic is based on 2 books. Managerial Accounting written by Garrison, Noreen, and Brewer. Management and Cost Accounting written by Drury. For more information, please visit the e-learning platform. By Karim Sharf. In this topic, we will study the decision-making process. Identifying objectives. The search for alternative courses of action. Gather data about alternatives. Select appropriate alternative courses of action. Implementation of the decisions. Comparing actual planned outcomes and responding to divergences. This figure presents a diagram of a decision-making model. The first stage represents the decision-making, or the planning process. Planning involves making choices between alternatives and is primarily a decision-making activity. The final 2 stages represents the control process, which is the process of measuring and correcting actual performance to ensure that the alternatives that are chosen and the plans for implementing them are carried out. Let us now examine each of the items listed in this figure. The first stage in the decision-making process is to specify the goals or objectives of the organization. Economic theory normally assumes that firms seek to maximize profits for the owners of the firm, the ordinary shareholders in a limited company, or more precisely, the maximization of shareholders' wealth. Some writers believe that businessmen are content to find a plan that provides satisfactory profits rather than to maximize profits. Because people have limited powers of understanding and can deal with only a limited amount of information at a time, they tend to search for solutions only until the first acceptable solution is found. Others have argued that the firm is a coalition of various different groups. Shareholders, employees, customers, suppliers and the government, each of whom must be paid a minimum to participate in the coalition. Clearly it is too simplistic to say that the only objective of a business firm is to maximize profits. The second stage in the decision-making model is a search for a range of possible courses of action or strategies that might enable the objectives to be achieved. If the management of a company concentrates entirely on its present product range and market shares and cash flows are allowed to decline, there is a danger that the company will be unable to generate sufficient cash flows to survive in the future. To maximize future cash flows, it's important that management identifies potential opportunities and threats in its current environment and takes specific steps immediately. The company should consider one or more of the following courses of action. Developing new products for sales in existing markets. Developing new products for new markets. Developing new markets for existing products. The search for alternative courses of action involves the acquisition of information concerning future opportunities and environments. Data must be gathered for short-term and long-run decisions, for example data on the selling prices of competitors' products, estimated demand at alternative selling prices. When the data have been gathered, management must decide which courses of action to take. In practice, decision-making involves choosing between competing alternative courses of action and selecting the alternative that best satisfies the objectives of an organization. Assuming that our objective is to maximize future net cash inflows, the alternative selected should be based on a comparison of the differences between the cash flows. The alternatives are ranked in terms of net cash benefits, and those showing the greatest benefits are chosen. Once alternative courses of action have been selected, they should be implemented as part of the budgeting process. The budget is a financial plan for implementing the various decisions that management has made. The budget for all of the various decisions are expressed in terms of cash inflows and outflows, and sales revenues and expenses. The final stage is in the process of comparing actual and planned outcomes in responding to divergences from plan represents the firm's control process. The managerial function of control consists of measurement, reporting and subsequent correction of performance in an attempt to ensure that the firm's objectives and plans are achieved. To monitor performance, the accountant produces performance reports and presents them to the appropriate managers who are responsible for implementing the various decisions. Performance reports consisting of a comparison of actual outcomes, actual costs and revenues, and planned outcomes, budgeted costs and revenues. Effective control requires that corrective action is taken. This slide presents the decision-making model. The first stage represents the decision-making, or the planning process. Planning process includes identifying objectives, search for alternative courses of action, Gather data about alternatives. Select appropriate alternative courses of action. The final two stages represents the control process, which is the process of measuring and correcting actual performance. In this part, we will study the basics of performance management. In this introduction, we will see why firms should pay attention to their performance. What does performance mean? We'll see the limits of performance management and the concepts of financial and non-financial performance indicators. All companies should achieve targets in order to survive, to be competitive, and be profitable. In other words, all companies try to be the best in its sector. As I said, according to the economic theory, firms seek to maximize profits for the owners of the firm. So companies try to be the best in its sector to satisfy its owners. As I said, decision-making model includes two stages. Planning process. Planning involves making choices between alternatives. Control process is the process of measuring and correcting actual performance. In order to know whether the targets are achieved, companies implement performance measurement. In general, there are two types of performance indicators: financial and non-financial. Other partners will check the performance of the company. Owner. To have a responsibility to make working capital investment decisions. Bank. To determine whether the company is solvent or insolvent. Suppliers. To know whether the company has financial or non-financial difficulties. Strike. Customers. A successful company is a company that has a positive image. Competitors. Check the performance of the company in order to benchmark and compare its performance with the competitor. What does performance mean? There are many definitions of performance. We can define performance as an accomplishment of a task, reach a target, for example, deliver customers in time. Performance signifies the means or resources used to achieve this target. To measure performance, we should take into account the constraints and the limits. Performance measurement is the process of assessing how successful or unsuccessful a business entity is in achieving its objectives or goals. Performance is assessed at different levels in the company. Companies need to implement process and tools in order to get a performance management. There are many tools of performance management such as balanced scorecard, activity-based management, benchmarking. A performance indicator is a measure of performance. There are quantitative and qualitative indicators. Example of indicators: turnover, delivery time, production efficiency, absenteeism, profit margin, EPS. Performance appraisal is a process by which a manager examines and evaluates an employee's work by using an objective criteria. The top management analyze and define the company's general policy and strategies. Targets are defined on the basis of the strategy and general policy. Targets are defined for each responsibility centers, unit of a firm. Budgets can be used as standards for performance evaluation, action plans to assess the achievement of goals. So before determining the performance indicator, the company should identify general policy, strategy and target to achieve. Sometimes in the company, the interests of different departments are divergent and sometimes contradictory. So financial and non-financial indicators should be taken into account to assess the performance. As part of the corporate strategy planning of an organization, the directors will define the objectives of the organization. These objectives may be organized into a hierarchy of objectives, the performance hierarchy. Performance measurement aims to measure how successfully the organization is achieving its objectives. The main objectives of a system of performance measurement are designing measures at all levels of an organization which are consistent with the strategy of the organization. Reward schemes should be based on performance of managers against the targets. Measures should be fair. Managers should only be judged on things they controlled. Controllability principle. Measures should be objective and quantifiable, not subjective. I repeat. Mission is reason for the existence of the organization. Corporate objectives. Objectives for the primary stakeholder groups increase the market value. Subsidiary objectives. Objectives for the other stakeholder groups reduce the amount of pollution. Unit objectives. Objectives for the operating departments, units, of the organization. Since there is a hierarchy of objectives, there will also be a hierarchy of performance measures. Performance targets and measures will be set at all levels within the organization. In a well-designed system, these targets and measures will be consistent with the organization's overall goals. In other words, the objectives should not be divergent. It's called goal congruence. Traditional performance measurement was based solely on financial measures. This was considered to be appropriate because it was assumed that the primary objective of all organizations was to maximize the wealth of their shareholders. It seemed natural, therefore, that focusing on financial measures would help to achieve this objective. Take a minute and read the information of this slide. Take a minute and read the information of this slide. Take a minute and read the information of this slide. Transfer price is an internal price used to record sales from one division to another. Many approaches used to set the internal transfer price. First, cost plus. The transfer price is set at cost plus a profit margin. Second, negotiated. The divisions agree a transfer price between themselves. And finally, market. When use the open market price for the transferred good. As I said earlier, traditional performance measurement was based almost exclusively on financial measures. They lead to excessive focus on cost reduction. Short-term cost reductions may be achieved at the expense of long-term performance due to the effect on staff morale, quality, and other factors. Financial performance indicators ignore the drivers of business success. The things which drive business success are quality, delivery, customer satisfaction, after-sales service. Financial performance indicators may measure success, but they do not ensure success. Since the 80s, many companies have started to develop non-financial performance indicators. Since companies have a hierarchy of objectives, they also have a hierarchy of performance measures. Take a minute and read the information of this slide. Part 2. Managerial accounting in the business environment. This part describes the larger business environment within which management accounting operates. It is divided into 3 sections. First, customer value propositions, organizational structure, and third, process management. Companies that adopt a customer intimacy strategy strive to understand and respond to individual customer needs better than competitors. These companies say to their target, "You should choose us because we understand and respond to your individual needs better than our competitors." Examples of companies that pursue this strategy include luxury hotels, Shoemaker. Companies that adopt an operational excellence strategy strive to deliver products and services faster, more conveniently, and at a lower price than competitors. Examples of companies that pursue this strategy include low-cost airlines, like JT4U. These companies say to their target, "You should choose us because we deliver products and services faster, more conveniently, and at a lower price than our competitors." Companies that adopt a product leadership strategy strive to offer higher quality products than competitors. These companies say to their target, "You should choose us because we offer higher quality products than our competitors." Examples of companies that pursue this strategy include BMW, Cisco Systems, Apple. In practice, one company may offer its customers a combination of these 3 customer value propositions. One usually overweighs the others in terms of importance. Decentralization is the delegation of decision-making authority throughout an organization by giving managers the authority to make decisions relating to their area of responsibility. An organization chart shows how responsibility is divided among managers, and it shows formal lines of reporting and communication. Business process is a series of steps that are followed in order to carry out some task in a business. A value chain developer, as shown in the slide, consists of the major business functions that add value to a company's products and services. The customer's needs are most effectively met by coordination in the business processes. In the next slides, we will discuss 3 different approaches to managing and improving business process: lean production, the theory of constraints, and Six Sigma. Before studying the 3 different approaches to manage and improve business process, namely lean production, the theory of constraints, and Six Sigma, let's explore the concepts of the PUSH approach. PUSH system. Manufacturing system in which production is based on a projected production plan. Raw materials are the materials that are used to make a product. Work in process inventories consist of units of product that are only partially complete and will require further work before they are ready for sale to the customer. Finished goods consist of units of product that have been completed but have not yet been sold to customers. A lean thinking model is a five-step management approach that organizes resources, such as people and machines, around the flow of business processes and that pulls units through these processes in response to customer orders. The first step is to identify the value to customers in specific products and services. The second step is to identify the business process that delivers this value to customers. The third step is to organize work arrangements around the flux of the business process. The fourth step is to create a pull system where production is not initiated until a customer has ordered a product. This facet of the lean thinking model is often called just-in-time production. The fifth step is to continuously pursue perfection in the business process. The result of this five-step process is to lower inventories, decrease defects, reduce wasted effort, and shorten customer response times. Constraint is anything that prevents you from getting more of what you want. The constraint in a system is determined by the step that has the least capacity. Examples of constraint. You may not have enough time to study thoroughly for every subject and to go out with your friends on the weekend, so time is your constraint. Al Amrain Holding, Moroccan company, has only a limited amount of land to develop as home sites and commercial lots, so its constraint is land. As I said, a constraint is anything that prevents you from getting more of what you want. As an example, long waiting periods for surgery are a chronic problem in hospitals. This slide illustrates a simplified version of the steps followed by a surgery patient. The number of patients who can process through each step in a day is indicated in the slide. For example, appointments for outpatient visits can be made from many as 100 referrals from general practitioner in a day. The constraint in the system is determined by the step that has the smallest capacity, in this case surgery. The total number of patients processed through the entire system cannot exceed 15 per day, the maximum number of patients who can be treated in surgery. No matter how hard managers, doctors, and nurses try to improve the processing rate elsewhere in the system, they will never succeed in driving down. In fact, improvements elsewhere in the system, particularly before the constraint, are likely to result in even longer waiting times and more frustrated patients and healthcare providers. The theory of constraints approach to process improvement involves 4 steps. Identify the weakest link in the chain, which is the constraint. Do not place a greater strain on the system than the weakest link can handle. If you do, the chain will break. Concentrate improvement efforts on strengthening the weakest link. If the improvement efforts are successful, the weakest link will improve to the point that it is no longer the weakest link. At this point, a new weakest link must be identified, and the improvement process starts over again. Six Sigma is a process improvement method that relies on customer feedback and fact-based data gathering and analysis techniques to drive process improvement. The term Six Sigma refers to a process that generates no more than 3.4 defects per million opportunities. Because this rate of defects is so low, Six Sigma is sometimes associated with the term zero defects. The DMAIC, define, measure, analyze, improve, and controlled framework has 5 stages. The define stage identifies the scope and purpose of the project, the flux of the current process, and the customer's requirements. The measure stage gathers baseline performance data concerning the existing process and narrows the scope of the project to the most important problems. The analyze stage identifies the root causes of the problems that were identified during the measure stage. The analyze stage often reveals non-value-added activities that should be eliminated wherever possible. The improve stage is where potential solutions are developed, evaluated, and implemented to eliminate non-value-added activities and any other problems uncovered in the analyze stage. The control stage ensures that problems remain fixed and that the new methods are improved over time. Corporate governance is the system by which a company is directed and controlled. If properly implemented, the corporate governance system should provide incentives for the board of directors and top management to pursue objectives that are in the interests of the company's owners, and it should provide for effective monitoring of performance. Enterprise risk management is a process used by a company to proactively identify the risks that it faces and manage those risks. Once a company identifies its risks, perhaps the most common risk management tactic is to reduce risks by implementing specific controls. Corporate social responsibility, CSR, is a concept whereby organizations consider the needs of all stakeholders when making decisions. CSR extends beyond legal compliance to include voluntary actions that satisfy stakeholder expectations. Stakeholders include groups such as customers, employees, suppliers, communities, stockholders, and environmental and human rights advocates whose interests are tied to the company's performance. Part 3. The architecture of a performance management system. We will study the following points: responsibility centers, types of responsibility centers, controllability principle, how to assess the performance, organizational structure, divisional organization as a concept. In this point, we will explore the manner in which an organization can be split into responsibility centers for accounting and financial control purposes. Responsibility center may be defined as a unit of a firm where an individual manager is held responsible for the unit's performance. There are 4 types of responsibility centers. They are cost or expense centers, profit centers, revenue centers, investment centers. Cost centers are sections of a business to which costs can be charged. A cost center in a manufacturing business, for example, is a department of a factory, a particular stage in the production process, or even a whole factory. The manager of a cost center is only responsible for keeping costs within stated budget limits. He has no responsibility for sales or profits. Revenue center is a responsibility center that is devoted to raising revenue or generating sales without any link to the associated costs. In other words, revenue centers aims to maximize the revenue without exceeding the allocated expense budget. Revenue centers might be encountered in the not-for-profit sector or in the marketing operation of a commercial organization. Profit centers are responsibility centers whose managers are accountable for both revenues and costs. A designated manager will be responsible for the successful running of the profit center. Investment centers are responsibility centers whose managers are responsible for both sales revenues and costs and, in addition, have a responsibility and authority to make working capital investment decisions. Cost center has the lowest autonomy because the manager is responsible for only costs. Investment center has the greatest autonomy because the managers are responsible for both sales revenues and cost and, in addition, has a responsibility and authority to make working capital. Take a minute to read the information of this slide. Controllability is the degree of influence that a specific manager has over costs, revenues or other items in question. The manager should be held accountable for variables they controlled that he has direct control over. Responsibility accounting. System that measures the plans by budgets and actions by actual results for each responsibility center. As I said before, a center should be accountable for what it is responsible for, costs for cost center. Income for revenue center. Costs and income for profit center. Costs, income, and investment for investment center. The most common structures are entrepreneurial, small and very centralized; functional, split into specialist departments, marketing, finance, etc. Divisional, split into autonomous business units, each containing the main functions of the business. This is usually done geographically or by product. Matrix, split into work teams where each member reports to 2 or more managers as regards different responsibilities. Division is an organizational unit with its own responsible management. It is normally a profit and/or investment center for accounting purpose. Thank you for watching.